Good afternoon, everyone. I'm Angie Sodi, Senior Vice President and General Counsel at American Management Services. On behalf of American Management and Duchess Capital, welcome. We're glad you carved out the time today. Throughout today's webinar, if you have any questions about the topics discussed, feel free to submit them by clicking the Q&A icon in your meeting controls. We'll answer those during a Q&A session at the end. Let's get to it. Today's session is called 3 Hidden Factors That May Be Keeping Your Portfolio Companies from Exiting. That title reflects something we hear consistently from PE firms across the sectors we work in, including industrial manufacturing, business services, healthcare, distribution, among others. The companies are performing, the capital has been deployed, and yet the path to exit keeps getting longer. What we found is that the drag isn't macro, it's operational, and it tends to show up in 3 specific places that don't always make it onto the agenda until it's late in the hold period. That's what today is about. You'll hear from 2 firms that approach this from different but complementary angles. Duchess Capital brings decades of Wall Street and portfolio advisory experience, including capital structuring, financial performance, and exit strategy. American Management Services brings nearly 4 decades of on-site operational execution across thousands of client engagements. Together, we've worked across the same 8 sectors that account for nearly 90% of middle market PE investment. That shared experience is exactly what we'll be drawing on today. Joe Zapula, Managing Partner at Duchess Capital, will open with a question that traditional financial reporting often can't answer. Is your portfolio company's growth actually building enterprise value, or just requiring more and more capital to sustain it? Michael Novielli, also Managing Partner at Duchess, will follow with operating autonomy and why founder or sponsor dependency is one of the most underestimated risks to transferable enterprise value. And finally, Lou Mosca, our President and CEO at American Management, will close the content with operational discipline, the difference between companies that drive real results and those that just stay busy. I'll come back at the end to bring it all together. Joe, it's all yours.
Thank you, Angie, and thank you all for joining us this afternoon. Over the last 30 years, Duchess Capital has analyzed many companies across a wide range of industries. While we focus on companies' historical results, our true goal is to learn where it's heading. We address 3 questions that help us determine if a company's growth is creating sustainable enterprise value. The first question, is growth becoming more capital efficient? Companies normally need additional working capital as they grow. But when the capital needed to support growth begins increasing faster than revenue, the business is becoming more capital intensive. To identify this trend, we compare its working capital velocity over time. If current working capital velocity is slowing compared to prior periods, each dollar of working capital is now generating less revenue than it did previously. Even if revenue and EBITDA are improving, the business can still become less capital efficient and potentially less attractive to a buyer. The second question we address is growth becoming more or less profitable? We compute the incremental EBITDA margin to measure how much additional EBITDA is produced by each additional dollar of revenue. If the margin is declining, EBITDA is growing more slowly than revenue. This is a strong indication that the business is not scaling efficiently and a red flag to potential buyers. The third question is the additional capital invested in the business achieving targeted returns. We calculate the return on the incremental invested capital to determine whether additional investments are actually building enterprise value. Even companies with improving revenue and EBITDA can create progressively less value when the return on incremental investments decline. We encountered similar issues several years ago in a turnaround fintech we made. As it grew, the company required increasing amounts of working capital. We've unfortunately discovered the additional capital was not delivering the returns we had projected. After taking a closer look at the company's operations, we tightened underwriting quality, improved collections, and reduced operating expenses. These changes made the company more capital efficient. As a result, profitability increased by approximately 300%, EBITDA margin improved by 9 percentage points. The return on additional invested capital exceeded our target, and we were able to exit this turnaround portfolio company generating a 17% IRR over 3 years. There are plenty of financial metrics that tell us how a company is performing. These 3 benchmarks help us determine whether performance is truly building enterprise value. We highly recommend analyzing your company's capital efficiency framework before pursuing an exit. Potential buyers most likely would before making an offer. With that, I'll turn the call over to Michael Novielli, who will discuss operating autonomy.
Thank you, Joe. You just touched on the importance of returns on capital. I'd like to discuss something that often determines whether those returns are ultimately realized. Everyone on this call understands key person risk. We've all answered diligence questions around management depth, customer concentration, et cetera. So the issue isn't just recognizing the risk, it's measuring it. And we refer to this as enterprise transferability. Can this business consistently fire on all cylinders without dependence on just a handful of executives? Enterprise value is transferred through leadership, through systems, through accountability. And when those elements reside with just a few individuals instead of the organization, value becomes discounted because execution is less predictable. So how do we improve enterprise transferability? We focus on three areas: people, process, and profit. Number one, people. Evaluate leadership depth, succession planning, and accountability. Who really makes decisions? Where does institutional knowledge reside? And who owns the customer relationships? Number two, process. Are processes documented? Are they repeatable and measured? Or does the business still rely on tribal knowledge? And number three, profit. Every operational improvement should contribute to margin, cash flow, or return on invested capital, as Joe said earlier. Establish a rhythm with KPI reviews, accountability, so performance becomes repeatable rather than personality driven. And Lou will touch on this next. So let me give you a real world example from our own experience. Duchess invested $20 million in an OEM where its founder built a successful business. However, the operational knowledge, the customer relationships, and the decision-making resided with him and not the organization. So when leadership transitioned, the knowledge never transferred to the new management team. And they spent more time learning the business than improving it. So performance deteriorated. And when the financial crisis closed our exit window, we wrote off most of the investment. But it reinforced a lesson we never forgot. Enterprise value isn't created simply because a founder builds a successful business. It's created when the organization's knowledge and relationships become institutionalized and transferable. So if you're holding an aging portco, don't assume that the risk disappeared when the founder did. In many cases, initial founder dependency simply evolves into dependence on a handful of key executives. And if you're preparing for an exit, ask yourself one simple question. If any one executive left tomorrow, would that materially disrupt the business? You'll find that answer will shine some light on the risks you should be addressing before you go to market. Further, I would encourage you to perform a dependency assessment before engaging your investment banker. Identify if and where there may be bottlenecks of customer relationships, knowledge, decision-making, et cetera. Those are risks many buyers uncover during due diligence. And as you all know, buyers don't buy yesterday's performance. They invest in the confidence of future performance. Lou?
That was great, guys. I appreciate that. So good afternoon. Thank you all for joining us today. And operational autonomy, along with operational discipline, are certainly concepts that most people can grasp. But along with operating discipline, our goal today is to provide solutions. Everyone's aware of portfolio companies not being sold. The question begs, how do we enhance profit? How do we help you drive incremental EBITDA? And how do we help you create an exit strategy that you can measure? So let's start with, let's manage by the numbers. Managing by the numbers cannot be a cliche. A few minutes ago, Michael referenced KPIs. Well, managing by the numbers with firm KPIs leads you right into total accountability. Numbers don't fib, people fib. Okay, so you really want to manage by the numbers, make it part of your religion. Sports. You know, football season's around the corner, folks. Lombardi's rule number one was always ask tough questions and make sure you get solid answers. You and your key management team, at whatever portfolio company you're holding, has to ask the right questions, tough questions, and hold themselves and their key players accountable to the answers and the results. So here's some numbers we suggest you watch. And we suggest you watch them like a hawk. Margins. If you know you need a 40% gross profit to be profitable, the last couple of years, 3, 4, 5, 6 years, labor, materials, insurance, fuel costs have all gone up dramatically. Everybody knows that. But if you need a 40% gross profit, you need a 40% gross profit. Can't deviate from it. A little while ago, Joe referenced free cash flow. Well, free cash flow is the barometer we use to determine if the business is really growing properly and is operating on all cylinders the way it should be. Debt service. A lot of portfolio companies have their own debt service and have debt. And unfortunately, a lot of it is not refinanceable at the moment. So how do you offset increased debt service costs? Well, the answer is you need to improve your operating margins, which ties you right back into operating discipline. The last digit we think you should be watching like a hawk is payroll. Not absolute dollars of payroll, payroll as a percentage of revenue. The quickest way to kill liquidity and kill profitability in my book is by payroll getting out of control. So we had a recent client engagement, $40 million contractor, really great guy, and he just wanted to sell his business after 20 years. He could bid work, he can gain work, he always got work, but he could not control his payroll. Worse than that, he refused to control his payroll. He was afraid he'd lose his people, and he won't let us do it either. So today he's dealing with a liquidity crisis. It's all self-inflicted problems, and he's not even close to selling his business. Control your payroll costs, guys. So how do you enhance and accelerate an exit strategy, you might ask? Well, your team has to execute at a higher level. It's easier said than done. And our strategy to accomplish this starts with training. So you inherited a team or you installed a team. That doesn't necessarily mean they are the right players. Most times they are, but they need to be assisted through discipline and consistent training. Next is profit management. So we split profit into two tiers. Tier 1 profit for us is what we call predetermined profit, similar to your hurdle rate. And predetermined profit for us, guys, is the first line item of expense. You modeled out that when you made this investment that you should make 8% profit. Well, if we're doing $100 million, 8% is 8 million. That's our first line item of expense. And we're going to teach the discipline to run the company on the other 92 cents on the dollar. Tier 2 profit is the profit that we're going to drive to. That's in excess of Tier 1. We use that profit to enhance growth and reward our key people through incentive comp. And it happens because of training and discipline. Doesn't happen because you put numbers on a paper. It happens because of training and discipline. So not too long ago, we worked with a $150 million distributor who embraced our concepts immediately. And today, that distributor is doing $300 million, profits being maximized every quarter, and the driver was Tier 2 profit coupled with incentive compensation. Back to sports. Floyd Mayweather. I watched a video years ago, maybe you've seen it. I want to win more than I want to breathe. That stuck with me forever. You need to have players in your organization that instill the desire through economics and incentives. And they embrace consistent training, and they are your warriors to get to the result that you need. So if you truly want to accelerate exit strategies, regardless of what industry your portfolio companies are in, here is our 5-point playbook for you. Number 1, manage by the numbers. Don't let up. Number 2, train, retrain, and retrain some more. Invest in your people. Number 3, Tier 1 profit should be an absolute non-negotiable number. Predetermined profit, your hurdle rate, first line item of expense, Tier 1 profit, non-negotiable. Number 4, Tier 2 profit is used to drive incentive compensation to keep all your key players in the game. And number 5, set the bar, measure it daily, weekly, monthly, and be relentless in doing so. So if you follow these 5 disciplines we just gave you, your multiples will take care of themselves, and you will see a ramp to an exit strategy. And this is what Duchess Capital and American Management Services bring to every client. Angie?
Thank you, Lou. And thank you to Joe and Michael as well. Let me take a moment to recap what you just heard. You heard from people who have been inside more than 15,000 businesses across the 8 sectors that drive middle market PE. You heard from a team that has not just sat across the table from GPs, but have actually been GPs. We know what your LPs are asking. We know what your boards are pushing for. and we know what buyers actually look for when they're deciding what your company is worth. Joe showed you that revenue and EBITDA can both be moving in the right direction, while working capital velocity and return on incremental invested capital are quietly telling a different story, one that will show up at the closing table whether you're ready for it or not. Michael showed you that the most common and most underestimated risk in a PE-backed company isn't market risk or credit risk. It's dependence on one or perhaps a few key executives, and that dependency has a direct, measurable impact on what a buyer will pay. Finally, Lou showed you that operational discipline, real discipline, not activity, is what separates the companies that hit their exit targets from the ones that keep extending the hold period. These aren't theories. We have delivered documented profit improvements across hundreds of portfolio companies and thousands of businesses. We know what works, and we know how to get there fast enough to matter for your timeline. Here's what makes us different from every other advisor in this space. Most firms come at your portfolio companies from one direction, either the financial side or the operational side. We work both at the same time on the same company. Duchess reads the capital structure and exit landscape. American Management is on site inside the operations. That means when we tell you there's a problem, we can also tell you exactly what it's costing you and exactly what it will take to fix it. That's not something most advisors can say. We can. These issues are real, they are measurable, and they are fixable. We've fixed them before across industries, across hold periods, across companies that looked a lot like yours. The first step is knowing where to look, and we hope today helped with that. If you have any comments about what you're seeing in your sectors or just want to review your portfolio, our contact information is on the slide deck, which we'll send to all attendees at the close. Also, we will be scheduling additional webinars in the future, which we will announce on LinkedIn as appropriate. Finally, let's take a minute to turn to your questions. And keep in mind, if we aren't able to get to everything submitted, we'll include a full Q&A document with a slide deck that we send after the close. So let's get to it. All right, so Joe, how does working capital velocity differ from the cash conversion cycle?
Good question. The cash conversion cycle measures how long cash is tied up in receivables, inventory, and net payables, while working capital velocity measures how much revenue each dollar of operating working capital generates. One focuses on the timing of cash flow, while the other measures how efficiently working capital generates revenue.
Perfect. Thank you, Joe. Lou, what can you identify that management, operating partners, and lenders have missed?
I think that, thank you, Ange. I think that operating partners and key managers are really good with understanding their business and the DNA of their business. What we look for is the people skills, the culture. What are we trying to accomplish with the folks that we have, and are they the right skill set to drive the results? So we look at people, we look at what Michael referred to before, a process, but we're really looking at how can those people execute to the plan we need to get to the result that we want.
Thank you, Lou. Michael, how do you actually identify enterprise transferability?
That's a great question. So as I mentioned earlier, we evaluated across 3 dimensions: leadership, process, and the impact that it has on the bottom line. So first, we interview management and review organizational structure, to identify where the knowledge and the authority are and where they're concentrated. From something as simple as an org chart to a RACI matrix: who's responsible, who's accountable, who's consulted with, and who's informed about certain decisions. And next, we evaluate the operating process to determine the levels of automation and repeatability, find the operating issue. What is the dependency risk? Where's the process risk? And then lastly, we evaluate how any dependency risk and lack of process may be impacting those key financial metrics that I mentioned earlier. Which financial metric is affected, and how does it show up financially?
Thank you, Michael. Lou, when you talk about training, how do 20 to 30-year professionals respond to that?
Well, most key employees, most key executives in an organization care about the organization that they work for. So it's a little bit of a culture shock to begin with, to have to train people or upgrade people that have been doing something for 10, 20, 30 years. But once they get that it's a benefit for them too, because we're going to drive to that tier 2 profitability, which includes incentive comp, then they usually embrace what we want to try to teach them.
Thank you. Michael, how do you quantify the return on improving operational autonomy?
So operational autonomy, enterprise transferability, it begins first as a qualitative assessment. Once you've identified the risks, then you establish what the operating milestones are to reduce those risks, such as transitioning customer relationships, delegating decision-making, and documenting the processes. And once you achieve those milestones, you should expect to see improvements in execution and the operating performance. And that's what you measure through your KPI. So that becomes the quantitative component of operational autonomy.
Thank you. Joe, isn't return on incremental invested capital heavily dependent on how invested capital is defined?
That truly is actually. There's no gap definition for invested capital. I mean, the key is to calculate it the same way each time to allow for meaningful comparisons over time. I would use operating invested capital to measure the return on operating assets throughout the investment period so trends remain comparable. Other commonly approaches are enterprise invested capital, net operating assets, and acquisition invested capital. But there's many ways of doing it. It really depends on the industry and sectors you're in and the components of your operation.
Thank you. Lou, can you explain this concept of tier 1 profit in more detail?
Sure. So most people look at profitability as a residual. It's what's at the bottom of the bottom of the income statement, what's left over after you take sales, cost of sales, SG&A, and they get to this number on the bottom of the financial statement. That's residual profit. We believe, and they feel good because they prepared a budget and maybe they came close. We believe you have a risk, you took a risk, you made an investment, you're responsible for a lot of things that go on in the business world. So you should get a minimum return, and we call that tier 1 profitability. So if you modeled out at 8%, we think 8% should be your level 1 profit, and we're going to show you how to run the business on 92 cents on the dollar. Not only that, we're going to show you how to do it as revenue goes up and down so that you're always going to get your return, and you got to demand it.
Thank you, Lou. And I want to thank all of the panelists for being here today. Thank you all for joining us. We've enjoyed having you. And if you have any questions at all, again, feel free to contact us. The information is on the slide deck, which we'll distribute to you at the close. Enjoy the rest of your day.
Thanks, guys.
Thank you.